Chris Zaccarelli. Chris, great to see you. Thank you so much for joining us. We want to talk about policy and how important these inside baseball conversations are. You've got House Speaker Mike Johnson telling me on Sunday Morning Futures he's aiming to send one reconciliation bill to Trump desk by the end of April. And then you've got Trump saying, OK, I'd like one bill, but I'm open to two. How important are the tax cuts as a priority for investors?
Tax cuts are really important, and as you discussed earlier on the program, whether they put it into one bill or into two bills, ultimately what matters most to investors is what's going to happen along the economic front. Clearly, the border is important. That's a very big political issue. It's a very big issue to many Americans. But from an investor point of view, you really want to see those tax cuts. You want to see deregulation, which we know is probably coming no matter what. And so those types of pro-growth policies are what are going to push this market higher. We've seen the last 2 years, the market's gone up quite a bit. It's been the most in 25 years as far as a 2-year period. So in order for that progress to continue and for us to keep moving higher, we are going to need some tailwinds, especially when you consider that tariffs and some of the other types of policies that will be pursued as part of this administration will be somewhat of a headwind. So we are going to need those tax cuts. They're very important.
Well, I mean, look, we saw a bit of a pivot in this market after the Federal Reserve turned real hawkish at the end of the year in that last meeting. While, yes, they cut interest rates, they basically made it clear that they're in no rush to continue this cutting spree in 2025. And yields went up. Take a look at the 10-year Treasury yield this morning, sitting at 4.64%. Chris, the Federal Reserve widely expected to take this pause at the first policy meeting of the year this month. Fed Chief Jay Powell signaling 3 cuts this year still. Fed Governor Lisa Cook issued more caution yesterday. She said that the labor market has been somewhat more resilient, while inflation has been stickier. I think we can afford to proceed more cautiously with further cuts. Meanwhile, Fed Vice Chair for Supervision Michael Barr, the agency's top banking regulator, has announced he will step down at the end of February. Members of the Trump administration criticized the Fed's aggressive regulation of the banking industry, of course, and that's one of the reasons that we're going to see a lot more deregulation, Chris. So what are your thoughts on the Fed moves and how that fits into your allocation strategy?
Yeah, so absolutely. The Fed has gotten more hawkish. Even though they cut in December, they signal that they're going to be doing a lot fewer rate cuts over this coming year. When we spoke on your program last time, we were talking about how the fact that the consensus was around 5 to 6 cuts coming into December and through the end of 2025, and that needed to be ratcheted back to a little bit lower than that. I'd say, again, we need to ratchet back rate cuts. I would expect 1 to 2 cuts for this year at most. And as they mentioned, in terms of inflation, if inflation remains sticky, they're likely to keep rates on hold for a much longer period of time. The 10-year Treasury going higher is a reflection of 2 things. It's both the fact that inflation has not come down as much as possible, so therefore the Fed will probably keep rates higher for longer, but it's also a reflection of higher economic growth. There's a lot of optimism that with tax cuts, with deregulation, the economy is going to run hotter than we previously expected. So that's a good thing. You want to keep in mind the two things that will balance. Would it be better for the market for the Fed to cut, all things being equal? Yes. But if we can have a stronger economy through tax cuts, through deregulation, expecting fewer rate cuts, which is what is part of our base case, I think makes sense, and I think that's okay for the market. The market can definitely go higher with fewer rate cuts if part of the reason there are fewer rate cuts is because the economy is doing so well. Yeah, I mean, I think it's a really interesting point. We've really seen large caps dominate not only last year, but really the last 2 years. It's been all about large caps, with mid caps and small caps being left behind. To the extent that small caps are much more rate sensitive, that's completely true, but they're also more tax sensitive as well. So if we can get lower tax cuts, lower tax rates, have lower taxes, as well as potentially a little bit more protection in the form of tariffs, it could be that the more domestically focused small caps will get some benefits despite the fact that rates are higher. But it's an interesting picture. We're only a few years into the new trading year, but I do think there's an opportunity for the market to broaden out. The fact that it's been all large caps for the last 2 years gives an opportunity for mid caps and small caps to do better this year. And we have that as part of our allocation. We think that is worth pursuing at this point in time because large caps have gotten so expensive.
All right, Chris, we'll leave it there. Thanks very much. Great to talk with you.